Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In today's video, we're going to be talking about how to invest in gold as a beginner. And if you've been following me on Instagram over the past few days, you've seen some of the stories that I've been posting about gold and silver. So gold has actually recently hit an 11-year high, trading at just above $1,900 an ounce. Some people are saying that this is due to endless money printing, as this shirt suggests. Some people are saying that it's a sign of a weakening, debasing US dollar. Regardless of your thoughts, this video is going to cover a few different things. We're going to talk about 4 ways to invest in gold. We're going to talk about some of the pros and cons in investing in gold. And obviously at the end of the video, I'm going to give my thoughts. Stay tuned. Okay, so number 1 is probably what everyone thinks it is when they think of investing in gold. This is the actual physical bullion, okay? This is the actual metal. So this is going to be either in coin or bar form typically if you're buying from a reputable source. This can be anywhere from 1/4 of an ounce all the way up to 400-ounce bricks. And if you can afford a 400-ounce brick of gold, more power to you. If you just do some simple math and multiply the spot price of $1,900 as it is right now at the time of this recording, multiply that by 400, you get $760,000 worth of gold. So physical bullion is actually priced about 1 to 10% over spot price. Typically it's 1 to 5% at any given time, but in times like this with endless money printing, a lot of people are not trusting fiat currency and there's a lot of demand for precious metals. That's why the price is going up. So now the dealers, whether it's a coin shop or an online broker, they're actually charging closer to 10% over spot. So if you don't know what spot price is, say gold is trading at $1,000 an ounce, for example. If you add 10% premium to that, you're probably going to be getting into that gold for about $1,100 an ounce, okay? So you also need to buy quality. What do I mean by that? The most popular types are coming from mints or they're coming from highly reputable sources. So you should only be investing in investment grade gold. That's the whole point of this. So you're looking for purity of 99.5% or higher. I personally only buy 99.9% or higher. So the most popular ways to invest in this, as I mentioned, are coins because of its divisibility and its ability to be stored very easily. So if you want to make a comparison to silver, right now it's trading at about 1 ounce of gold can buy you 83 ounces of silver. That's 83 times more space if you're comparing apples to apples, if you're comparing a gold coin to a silver coin. So gold is actually highly divisible and it doesn't take up that much room, okay? If you want to know where to buy this, that's the whole point of this video on how to invest. I've been buying all my precious metals from jmbullion.com. I've left a link in the description below, and I actually found this receipt from about 5 years ago. They're highly reputable, they have fair prices, and the shipping is very discreet and very quick, and it comes straight to your door. So check out jmbullion.com. If you don't trust the online sources, which I don't know why you wouldn't, I would actually check out a local coin shop or potentially a trusted broker. So that's number 1, physical bullion. Let's go on to number 2. Okay, so number 2 are gold ETFs and gold funds. This sounds exactly like an ETF or a mutual fund. Well, because they are. They trade just like stocks and ETFs. So this is referred to as paper gold. There are 3 types of these ETFs and funds that exist, and I'm going to go over them very briefly in this slide just because it does pertain to ETFs and funds, and I'm going to go into a little bit more in depth after this slide into these. So the first kind are investing in a company or a ETF or mutual fund or an intermediary that actually invests in the physical bullion as we mentioned in the previous slide. So you can actually pool your money together, they hold the physical bullion, and they basically mimic the spot price, if you will. Now, the second way are investing in ETFs or funds that invest specifically in gold futures contracts. So these are companies that do exactly what the first example does, except they're not holding the physical gold and they typically don't take delivery. They're literally just betting on the future price of gold. And then third, you have gold mining companies, which have become very popular over the past few weeks. And this is exactly what it sounds like. You're investing in an ETF that owns a bunch of gold mining companies, and that performance is based on how those gold mining companies do. So very simple. So if you want to look at an example of a fund or an ETF that holds the physical bullion, here we have the Spider gold shares. This is basically ticker symbol GLD. And what they do is, as mentioned, is they hold the physical bullion, which invests directly in gold. So that ETF is typically going to mimic the spot price as mentioned. So GLD, however, you need to realize what you're doing when you get into something like this specifically. It's actually referred to as a collectible, meaning that the capital gains tax is going to be higher than other ETFs. So you need to be cognizant of that when you actually dispose of your position, because you're going to be paying a higher tax, potentially up to 28%, I believe. Number 3 is investing in the actual gold mining stocks, aka gold miners. So gold mining stocks are literally what they sound like. These are companies that actually mine for gold, duh. So how do you think it gets out of the ground? You have to invest in these companies that mine it and bring it out of the earth. So these companies don't necessarily correlate exactly with the spot price. So that's what I meant here by does not equal the spot price, just because these are still individual companies that need to be properly run. They need to show a profit. They need to increase their revenue in order to increase the value to their shareholders, aka increasing the value of the stock. So they still have to manage money, people, resources, equipment, all that stuff. So just because the spot price of gold is exploding doesn't necessarily mean that these companies will as well. So if you want a couple examples, 2 of the biggest gold miners out there are basically Newmont Corporation, and then you have Barrick Gold. And then finally, what I wanted to mention, over the past few weeks, junior gold miners, that's a classification in and of itself. It's kind of vague, so I didn't want to get into that. However, junior gold miners have actually been exploding in value. There's a lot of money flowing into them. So if you want to do further due diligence, again, this is at the time of this recording, but I would look into junior gold miners again. This is not investment advice. I'm wrong 100% of the time. Okay, so number 4 is investing in gold futures or options. So the reason I have an asterisk up here next to this is because this is for advanced traders only. This is for people that either do this as a living or have been doing it for many, many, many years, and they know exactly what they're doing. The reason I included this in a how to invest in gold for beginners video is because this is one of the strategies that gold ETFs and funds use. So I thought that it would provide value to the audience to be able to explain this to you. That way you understand what you're getting yourself into if you choose to invest in that kind of an ETF or gold fund. So as mentioned, these are basically the options on futures or ETFs. So if you don't know what an option is, it's basically the right, not the obligation, to buy or sell an asset at a certain price at a certain time. So if you don't know how options trading works, you can actually check out some other videos. There's a million videos on it. That's not the scope of this video, but just know that it's the right, not the obligation, to strike on a certain price and execute on that price in the future. So if you think the price of gold is going up or down, you can effectively place a bet on that with put or call options, which you can do your own research and figure out what that means. So with all that being explained, let's go into some pros and cons of investing in gold. Okay, so very quickly, let's run through the pros of investing in gold. There's obviously more than these 3, but these are the typical main points. So number 1, it's obviously a hedge against inflation, okay? So when you see the money printer going burr and printing trillions and trillions of dollars, people lose their confidence in fiat currency, so they go back to something that is a historical store of value. So there's a finite amount of it, it's considered hard money, and this is to battle decreased purchasing power, okay? Ever since the United States went off the gold standard in 1971, you can do your own research, okay? And again, it's just a store of value. Number 2, portfolio diversification. So mostly everything you're invested in, whether it's ETFs, 401ks, bonds, all this stuff, it's all linked to the financial markets, okay? So they're tied to the markets in some way. This actually is a non-correlated asset, which actually provides diversification outside of just equities or stocks. So when you see your favorite YouTuber say, buy stocks, they only go up. Yes, that's fun, but that's not necessarily a good way to diversify. I actually had someone on Twitter ask me, do you recommend a certain portion of ETFs and stocks and this and that? But he didn't realize that he was talking all about stocks. So if stocks go down, it's going to go down, period. Doesn't matter how well diversified you are. You need to provide true diversification and introduce that to your portfolio. You can do that through precious metals, such as gold. And then finally, it's easy to get started, okay? So all you need to do is literally go online. If you go on jmbullion.com, you can literally get started today. It takes 5 minutes, not even. So ETFs and funds are just as easy as buying a stock. So those gold ETFs and funds that we mentioned, if you already have an open brokerage account, you can literally get started in investing in gold in a click of a button just by buying shares of those ETFs or funds. So it's very easy to get started. Okay, so finally, the cons of investing in gold is pretty simple. It doesn't earn anything. It is literally a pet rock. So if you invest in the physical bullion, you're gonna throw it somewhere in a safe or at a bank or safety deposit box, and it's literally just gonna sit there. There are no dividends, no compound interest, and no passive income coming from that investment, okay? It's a double-edged sword because that's why people invest in gold in the first place, because it's not correlated and it can't do those things. Number two is storage. So where can you put it? Are you gonna keep this in a safe in your house? What if someone knows it's there? You're gonna get robbed, dude. So you may wanna keep it at a bank, and even then, what if there's a run on the bank? What if that bank, burns down? Yes, there's insurance. Not the point of the video. My point is that if you invest in physical gold, storage could become an issue. And if you are, like Scrooge McDuck and you're just swimming in it, the actual physical amount of gold that you own can actually start to outpace the size of the safe that you keep it in. So keeping it off-site has trust issues, keeping it on-site has safety issues, so the storage is kind of a pain in the butt, and that's definitely a con. And then finally, I alluded to this earlier in the video, you're paying a premium over spot, and then you also have taxes as a collectible when you go to dispose of your position, okay? So basically the premium we mentioned is anywhere typically from 1 to 5%. Right now in this environment, it's right around 10%. And then this is also taxed as a collectible up to 28% of the value. So now that we mentioned the 4 different ways, the pros and cons, I'm gonna go into my thoughts at the end of the video. Okay, so my thoughts, that's a brain, okay? It looks like a walnut, it looks like a hairball, it's my brain, okay? That's your brain on drugs. Just kidding, not on drugs. Unless you consider coffee a drug. Well, coffee is a drug. Never mind. So anyway, my point is that this is a great way to diversify your portfolio. I believe that everyone should have at least 5 to 10% of either gold or precious metals to make up their portfolio. Silver is actually very underpriced right now. It's not the point of this video, but gold has typically been a better store of value. They're both running right now at the time of this video, so I would keep a small percentage of my portfolio in physical. Yes, you can't go to Costco and give them a silver bar and expect to get groceries for it, but that's not really the point. The point is to preserve wealth. If you're younger watching this, you probably think, I'm an idiot or a psychopath for wanting to do this. As you get older and you start to build more value, you want to be able to preserve your wealth and have something tangible. So a well-diversified portfolio, in my opinion, is going to be a little bit of precious metals, a little bit of real estate, assets, and then you have your typical usual suspects, stocks, bonds, things like that. And then also, 2020, go into crypto. Now the video is going to get downvoted because people don't do their research, and here we are. So I hope this video was valuable. At the end of the day, the money printer can only go burr. Interest rates will not go up in any time in the near future. That's why gold is actually such a valuable asset at this point in time. Hope you got value out of the video. Please like and subscribe and share the video with a friend. Check me out on Instagram if you haven't already, and check out JM Bullion down below. Thank you so much and have a prosperous day.
Oh, baby. Oh. Yes. Burr, baby. Yes. We're rich. We're rich. We're rich, Laley. We're rich. Yes.